Good afternoon, Europe. Good morning, New York, and a very warm welcome to today's live webcast, How Diversification Can Add Value to Investors. I'd like to quickly introduce today's panelist, Roy Niederhofer. Roy is the founder and president of RG Niederhofer Capital Management, a New York-based 27-year-old quantitative trading advisor. And on the other hand, Stefan Tittel and Mehdi Sajid from Quantum Rock. Stefan is the CEO and one of the founders. Mehdi is the head of derivatives trading. Quantum Rock is a Munich-based artificial intelligence technology asset manager founded back in 2012. In addition, on the panel is my colleague Beat Decker. Beat is a senior advisor at RML. My name is Rainer Lang, and I'm the founder of RML Advisory. Before we digging in, I want to make you aware of the following compliance statement. Sorry for that, but that's for legal issues. We need to do that. So this webinar is hosted for information purposes only and does not constitute or should not be seen as an investment advice or a recommendation to buy, sell, or otherwise transact in any investment, including any products or services, or an invitation, offer, or solicitation to engage in any investment activity presented during this webinar. Just a few words about RML. We are an independent, owner-managed, and nimble Swiss-based investment advisory firm with a global orientation and no conflicts of interest. Founded in 2017, we source and work with a limited number of high-quality investment managers in the alternative and in the traditional space that provide best-in-class active investment management and develop long-term partnership. We strongly believe that the managers we are working with have not only a passion for managing money, in fact, they are intrinsic motivators and work in the interest of their client. Why do we believe that diversification is key to manage risk, and why is it now paramount more than ever? Firstly, times are more uncertain than they have ever been in years. And secondly, because late-stage market dynamics tend to generate a great deal of volatility and can cause strong correlation between equity and bonds. An allocation to alternative investment that exhibit lower volatility and an uncorrelated return profile to risk assets is therefore, in our view, a viable investment strategy. Conventional wisdom regarding asset allocation reminds investors that they can reduce risk through diversification because historically, the returns of stock, bonds, cash, and other asset classes haven't moved in unison. However, diversifying your assets into multiple asset classes, hoping those assets go up when the stock market goes down, is in our view not the best way to protect your risky assets in a portfolio such as, for example, equities. Ultimately, we believe the only two things that matter when it comes to achieving diversification is correlation to equities and liquidity. Therefore, more important than just a mix of assets is recognizing how each of these assets behave in different markets and as a consequence, how to position and weight these assets. Our proprietary Global Alternative Smart Alpha portfolio is based on this approach and philosophy. In consideration of these findings, we have been setting the following parameters. First, we wanted to construct a portfolio that is able to achieve an optimal risk-return profile and producing asymmetric returns in relation to long-only investment strategies. Then we set up a volatility target to be 4 to 6% and a monthly VaR of 3%. The correlation should be around 0 or very low to negative, and we are aiming for the Sortini ratio to be 5 or even higher. We found the best way to achieve this is to run a concentrated basket with regards to the managers in the portfolio, but moreover, to avoid an overlap of the underlying strategies. On a look-through basis, the portfolio allocates to 14 different strategies. Now, why did we select RGN Smart Alpha 2X? Firstly, we were looking for an allocation to a fixed income and Roy's investment program is a very successful and broadly diversified strategies. It trades 21 extremely liquid global fixed income and FX markets. Secondly, because the fund has demonstrated downside and upside protection and has a long history of crisis alpha. And thirdly, because it means a lot to us that the team leaders of the firm have an average of 15 years of tenure at the firm. Why did we select Quantum Rock VSOP? Firstly, we believe that Quantum Rock is a very interesting and unique asset manager as the firm's systematic scientific process is driven by proprietary statistical methodologies using machine learning and artificial intelligence. Secondly, VSOP's return distribution shows smaller negative tails compared to a balanced portfolio consisting of equity and bonds, and this fact is very constructive for our strategy. And thirdly, we were also impressed by the complementary team leaders consisting of fintech entrepreneurs, quants, software IT specialists, algorithmic and derivatives trading, and machine learning. With that said, I would now like to hand over to Roy to present the Smart Alpha strategy. I'm going to stop my screen share here.
I began trading in the summer of 1987, and on one sunny Monday, I walked in having developed some mean reversion fixed income trading strategies over the first few months of my trading career, and I had a nice long 30-year US bond position. And everything seemed fine until that happened. And my firm that I was working for went bankrupt at 3 o'clock. So it wasn't a very auspicious first few weeks of my trading career, I was thinking, as stocks were down 18 or 20% at 3 p.m. But then something miraculous happened. The US bond market went up 7 points, the biggest rally it had ever had, from 3 p.m. to 5:15 p.m. And not only was the firm back in business again that I was working for, but I had the biggest profit that I saw in the first 5 years of my career. And I learned a very important lesson, that the Fed was going to try in every possible way to provide liquidity to the markets whenever there were issues with the equity markets. Our whole careers have been spent in this world where fixed income has been thought of as a tremendous diversifier for stocks. And right now, over the last 27 years of my firm's trading, we've seen client after client who is using fixed income in their portfolio in various ways to protect and, in a sense, do what happened in 1987, provide a positive return put on equities. Now, positive return puts shouldn't really exist in pure forms. So what's going on? Why do bonds have that characteristic? And will they continue to have that characteristic? Now, I think most of us think of the world as one where stocks and bonds are diversifiers. But I want to show you now some research that we just did that I found pretty shocking. We just divided the world up into two types of days. Days that the MSCI World Equity Index is up, and days that the MSCI World Equity Index is down. Now, if what I said before is true, if bonds are a positive premium, positive return put on stocks, it should be that on down days for stocks, bonds are going up. But look what's happened since about 2003. The orange is the cumulative return of Barclays Global Ag Bond Index, just a big broad index of global fixed income on down days for stocks. And you can see that it's been pretty miserable. On the other hand, up days for stocks have been fantastic for bonds. So what is this telling us? It's telling us that the conventional wisdom that stocks and bonds are diversifying assets is a myth. We believe we can do better, and our firm exists to try to do better than this kind of negative return in down days for stocks. And along the way, we're also going to try to do the same thing in down days for bonds and for hedge funds. I'd like to make another longer period analysis of this problem. Here we ask the same question for stocks and bonds using monthly data. So we're just going to focus on the right over here. This is a portfolio of 100% MSCI World and 100% overlay with Barclays Global Ag Fixed Income. And what you see, these lines represent the capture ratios of up and down months for stocks. So a positive capture ratio means you're getting better performance than you would have without the overlay in up months. And the negative capture ratios over here, the downside capture ratios, this is how small the down months are. So ideally, you have something that's going up in the up months. You make more when stocks go up and lose less when stocks go down. But look what happens. It turns out that for fixed income, you make 120% more, 1.2 times your return in up months for stocks, but only 3% smaller down months. So again, on monthly data, it's confirmed that fixed income doesn't help an equity portfolio. So a lot of people have recognized that you might be able to do better, and they look at CTAs. And by CTAs, we're using the SG CTA index, mostly trend followers. And look what we find here. The same two numbers, your up months for stocks are 119% of what they would be. So your up months get better, but your down months are only 2% smaller. They're 98% of the size. What this is telling us is that CTAs too don't provide downside protection. So what do? We believe that we can do better, and the reason that we are incorporated in this broadly diversified portfolio is that our Smart Alpha program is designed to provide consistent returns in the worst drawdowns for MSCI World and other equity indices. And what we're showing here is the cumulative return in the 25 worst drawdowns for stocks around the world and how hard it is. Look at all the different styles that we have down here. It's every type of hedge fund. It's macro CTA. Everything is down. And that means that equity drawdowns are very, very difficult for diversified portfolios. And we try to specialize in making money during this type of event. So now let's get to Smart Alpha program. We're obviously in a nice volatile environment right now, which is good for us since the fund is designed to systematically capture short duration realized volatility. Overall, this fund has had a 10% return and 10% volatility for about a 0.9 Sharpe. So on a standalone basis, this is a pretty interesting product. And it's very liquid. We have daily liquidity. And that's because we are trading the most liquid markets in the world. Our goal is to provide two-sided protection for both stocks and bonds. In other words, the largest declines and the largest rallies for stocks and bonds are supposed to be our best opportunities. That's very different from most portfolios, which do better when markets are quietly rallying or doing nothing. That's when risk on and short vol strategies do best. And the goal is to have much greater than 100% capture ratio of up months for our clients' portfolios, but make an enormous difference on the downside by providing protection. We're using a systematic strategy in liquid FX and fixed income markets using rules that capture investor behavioral biases, built-in instincts that cause people to trade ineffectively and suboptimally, either discretionarily or even using systematic strategies. And I'm going to come back to that. Our flagship program, which goes all the way back to 1993, has a long history of providing crisis alpha. You can see some of our returns in the mortgage-backed crisis, LTCM, the tech crash, 2000 to 02, all the way through. And even this year, you may have seen this article in Bloomberg. This is our flagship program. It's up 45% this year. This program, the Smart Alpha program, is a quieter version. It doesn't trade equities, so it's not just an equity tail risk program. It's designed to be year in, year out, a good performer with tail risk characteristics. As Reiner said, we have a lot of history doing this. All of our team has been with me a very long time, especially my CIO, whose name is Paul Shen. Here he is. And he started the business with me in 1993. Now, this picture, it's not quite accurate anymore because this is not what we look like. No one wears suits. This is more like it. It's the R.G. Niederhofer distributed version. We're all trading out of our own places. We've discovered that the office, however, is a very good place for plants to grow. So these days, our office is more like the jungle and fairly uninhabited. So I'd like to tell you a little bit more about how we fit into the world right now. Obviously, there's a lot of potential tail risks. This chart is from the end of October, but you can see that people are obviously still concerned about COVID-19. Even with vaccines, we still don't quite know how fast that vaccine is going to come, what kind of restrictions, what kind of economic impact there's going to be, and also what the long-term impact of all of us sitting at home instead of being in our offices is going to be. And certainly all of these other tail risks are quite important to think about. What's interesting is that they're not all negative tail risks for equities. What I think of as a credit event could also be defined as central bank balance sheet expansion, which would be fantastic for equities and terrible for fixed income if all the trillions that are being printed somehow make it out into the real world and cause inflationary pressures. So there's a lot of ways that stocks and bonds could go in both directions, and we're going to focus on that. In terms of the US election, this tail risk isn't over yet. Right now, this is something called FTX Trump Feb, and it's a cryptocurrency that is a prediction as to what the chances are that Trump is in office on February 1st. And that thing is currently trading at 15.5%. So basically, that's saying that there's a non-zero chance that the US election is going to Trump, not to Biden. So we'll see what happens there. Now, in terms of our track record, I just want to focus on a few things on this chart. There's a lot of numbers, but let's just look at up the top, the return, which is fine. There are a lot of funds, however, that do better than a 0.8 Sharpe. I'm sure you can find them. I'm sure you have many of them, but we're pretty happy with that. I'd call it top quartile performance. But what makes us interesting is that we're doing this with negative correlation to stocks, all the different types of equity portfolios, and bonds. You can see over here. So this is truly protection, not just diversification. We're even negative 0.2 correlated to hedge funds and very low to trend following CTAs, only 0.2. So that means we're providing about 9 to 12% each year of portable alpha when overlaid on top of any benchmark portfolio. At the same time, as you can see here, we're outperforming all of those benchmark portfolios with negative correlation to those portfolios. So that makes this a pretty interesting addition to an existing portfolio. What we trade is a broadly diversified mix of fixed income and foreign exchange, which we trade in cash and futures. You can see there's a lot of different ways for us to trade the yield curves of Europe, of the US, and also to capture not only the developed currencies, the major currencies, but also a little bit of commodity currencies here. Canada and Aussie are in there too. The way we're able to provide the downside protection is by providing convexity without the cost of premium. On the left, you see very clearly the response of our fund to the daily change in global fixed income. Again, Barclays Global Ag. The more it's down, so if Barclays Global Ag is down 1% or more, we're up 0.54 on average. If Barclays Global Ag Index is up 1% or more, we're up 0.37. And so that's convexity. But normally when you buy a straddle, it's below the line. You're paying for the unchanged days. And you can see that that's not the case. So in pretty much all bins, we're positive, and we love the volatility. Now look at CTAs. Trend following is basically, according to this chart, a long fixed income position that never goes short. As you can see, the more bonds go down, the more trouble trend following has. There are a lot of structural reasons for that, which if you ever want to hear more, we're happy to chat about that. We've written white papers on this. But it's not just fixed income convexity. We're providing equity convexity as well. Over here, you see the monthly change of the S&P 500. And remember, we're not trading stocks. So it takes a little bit of time for equity market declines to filter into other markets. The volatility eventually percolates to other markets. So you can see the more stocks go down, if stocks are down 5% or more in a month, we're up an average of 2.6. If they're down 2.5 to 5, we're up 2.1. And then up here on the right side, you see that we're up 0.9 when stocks are up 5% or more. So that's good too. And now in black, we see that hedge funds are static long equities. I don't think that's a surprise to anyone now. We've been talking about this for over 20 years. Hedge funds are essentially a 0.3 beta investment in the S&P 500. And you can see that very clearly here. So let's now look at the tails. Do we actually provide tail risk protection on the upside and the downside? We're always in orange. You can see here on the left side, we have the 25 worst drawdowns for bonds and the 25 worst drawdowns for stocks. And the other lines are hedge funds and macro CTA. So you can see that when bonds go down, basically nothing is up and most hedge funds are down. Most hedge fund styles are down. When stocks go down, macro CTA and all the hedge fund styles are down. I don't think, again, that's not a surprise. We've seen that over and over again. We've seen it this year. But what about the upside? We have to be concerned about deflation right now. What if we get negative rates in the US? Well, that's also pretty good for us, but it's also good for everybody except for market neutral. Why is that? I think perhaps because some of these big run-ups are flights to quality that produce out of range movements for market neutral equities. And then on the bottom, stock run-ups. What happens if stocks just go to the moon? This isn't the best for us. We're only up 30% net and all the other hedge fund styles are up. You can see straight lines up. Probably you don't necessarily need us in a portfolio if stocks are going to have one of their 25 biggest run-ups. But it's really the other three that we truly excel at. And you can see why it's important to have us in a portfolio. The left side of this chart is pretty grim. Bonds go down or stocks go down. Multi-asset portfolios typically have great problems. I'm just going to give you a sense now for the value of our fund in a portfolio. Now, we're being used at a 20% level in this portfolio. So we're somewhere in between these two columns, but basically the idea here of this chart is that we make a positive difference on the upside. When the rest of the portfolio is making money, we increase that amount of money, but the downside gets much smaller. So I don't have it circled at 20%, I have it circled here, but at this 50% level, adding our fund to MSCI World gives you triple the Sharpe ratio, 4 times the total return. You're still 0.94 correlated with MSCI World, and you have 6% of annualized alpha every year compared to the original portfolio. So basically, this is a wonderful overlay on top of equity risk, and you can see the value of this for pretty much any portfolio. This is true. This chart, of course, is MSCI World. We have similar charts for bonds, for hedge funds, for CTAs. There's always enormously higher return and enormously improved Sharpe. And by the way, we're not just up leveraging the risk. The combined portfolio here has 14.8% volatility. MSCI World begins at 15.3. So this addition is actually reducing the overall risk of the portfolio. So How are we doing this? I mentioned behavioral finance, behavioral biases that people have. This should remind you all of this gentleman, Danny Kahneman, who in this book, Thinking Fast and Slow, codified all of these biases that investors have. I think it's the greatest book on trading ever written, although it's not really about trading, it's about human behavior. And if you don't have this on your shelf, I encourage you to read it. It's just fantastic. I had the pleasure of working with Danny on a presentation about why it's so difficult for investors to have protective strategies in multi-manager portfolios, yet every investor in the world has fire insurance with negative infinity Sharpe ratios. If you think about that, the Sharpe ratio of your fire insurance is negative infinity. But we don't look at it as a standalone investment. We came to the conclusion that because diversifying assets frequently show up at the top or bottom of monthly performance tables, they're harder to keep in a portfolio than assets that are correlated to everything else in the portfolio. The way we approach the question, how do biases allow a trading strategy to be created, is by following this path. We begin by identifying a behavioral bias that we'd like to study, which is then quantified into a testable hypothesis. We then test this on 35 years of historical intraday price and volume data and evaluate the quality of the new potential rule that we'd like to follow, both on a standalone basis and its impact to our portfolio. We are trading patterns that represent the lived experience of people trading markets, what they feel when they trade on a day-to-day basis, not quantifiable parameters that no one really experiences, like moving average crossovers, but things like anchoring, the way in equity markets, people became anchored to the high in February. And when it got further and further away from that, it got more and more scary. Things like recency bias, how recent something occurred, loss aversion. Did new investors recently take a loss on something that they've just put on as a position? And more and more. And we have a lot of examples of this that we can go into if you ever want to hear more, but in the interest of brevity, I'm just going to give you a broad description of what our strategy looks like. We're trading with an average duration of 1.5 days. Our trades can be as short as a few minutes and as long as 5 to 10 days. We're using a mix of contrarian mean reversion strategies and momentum strategies, as well as a machine learning section that incorporates aspects of all of these. And where we differ from CTAs is that our holding length is much shorter. CTAs are way out here at probably months to quarters as an average holding length, and also are mainly trend following. So what this looks like on a day-to-day basis, when things are quiet and break out of a range, we're going to look like a short-term trend follower. Our models will try to get on board the new trend. As that trend gets more and more pronounced, we're going to try to reverse that trend and find mean reversion opportunities. And this is the US 10-year note this year. And you can see what it did. As COVID started in Japan, bonds started to go up, a note started to go up. This is the US 10-year. And we started to get long, but then got out of some of our positions in February when it got a little volatile and things paused as people evaluated whether it would hit Europe and the US. And then it really started to go an enormous trend, which was great. But then it got super volatile in March. This, in fact, was the most volatile period in the history of the fixed income market, that 3-week period. You may have noticed that in this 3-week period, bonds went down as stocks went down. Again, emphasizing what I said before, bonds do not provide a diversifying asset. They, in fact, duration became a risk asset at the height of the COVID panic in mid-March. When don't we do well? An example of that is when markets are super quiet, like the first quarter of 2017. In this period, it was the least volatile quarter for fixed income. Of course, stocks were going through the roof under the beginnings of the Trump administration, and this became one of the best quarters for most people's portfolios, but it was pretty bad for us. we prefer volatility. I have on my phone here, I don't know if you can see this. We really do love volatility. So schematically, when things are in a very tight range and markets are very quiet, like in September, trading the same price over and over again, day to day, that won't be so good for us. Our favorite environment is a ball bouncing down a flight of stairs, like we saw in October. And you can see the bounces here, 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 here. And that should be pretty good for us. Now, overall, our goal is to provide portfolio improvement. And here we're just showing it once again, the amazing improvement that we can provide to existing portfolios. And you can see here for global bond portfolios, for global equity portfolios, and for hedge funds. A 10% addition, just 10% allocation to our fund, makes a 43% difference in Sharpe ratio for a bond portfolio, a 63% improvement in Sharpe for an equity portfolio, and a 77% improvement for a hedge fund portfolio. And the total return numbers are also enormous, as this enormously improved at the same time that drawdowns get smaller. So just to summarize, this is a program that is designed to have positive return along with about a 0.9 Sharpe over long periods of time with negative correlation to stocks, bonds, and hedge funds. We're using a combination of momentum and mean reversion systematic trading styles with a very short duration that rapidly adapts to changes in market regime. What this does is give us a long realized volatility profile. The more something moves, the better we're tending to do in it. It's convexity with a positive return, not a premium cost. Because of that, we're able to provide reliable downside and upside protection for fixed income and equity and even hedge fund portfolios, even before a large trend is established. And because of that, we make a very large improvement to existing portfolios. And we look forward to being a part of this portfolio to help provide similar benefits to it. So with that, I will pass it back. And I want to thank you for listening.
Thank you very much, Roy, for this very interesting insights into your firm and your strategy. I'm sure we're going to have a couple of questions afterwards.
Sure.
With that, I think I would like to hand over to Stefan and Mehdi for the Quantum Rock VSOP strategy and how this is has all been set up. Stefan, up to you. I think you want to start, or?
Yes, I will. Just a moment. Let me bring up the screen. So do you have it now?
Yes.
Excellent. Rainer, thank you very much. It's a pleasure to be here and give our view on things and to give you a short introduction about ourselves and most importantly about our strategy. Yeah, Quantum Rock is a little bit a different kind of animal. We founded the company in 2012, and as tech entrepreneurs, the initial notion was it must be possible to find a systematic answer, a systematic solution based on technology to trade in changing markets more effectively. And as a matter of fact, we spent 6 years to develop an AI and machine learning platform, which sort of solves the problem I just mentioned. We are a group of 15 people consisting of very experienced capital market experts, but on the other hand as well, artificial and machine learning gurus, you should say. As we speak now, we are one of the very few pure-blood AI players in the hedge fund industry out there. And among the AI players out there, we are the one who is performing consistently good for the past 4 years. And as you might know, there are also not so many at all who have a validated track record for AI-based, machine learning-based investment strategy. When we compare ourselves to our competitors, which are AI machine learning-based funds, We provide the highest Sharpe ratio since 2016, since we are trading this program. We are standing for a symbiosis between capital market experts and knowledge and technology, as I said already. And over the past 4 years, we have shown a solid performance of around 16% average return a year with a Sharpe ratio north of 1.20, which is compared to many other products out there quite good. This year we are doing especially well, and I will go into the details a little bit later, and my colleague Mehdi as well. Our investment products are available, or our investment program is available via a UCITS fund, as well as separate managed accounts, and it's also resold by Deutsche Bank to the institutional client base through their DB Select platform. So what is this all about? I mean, when you look at the markets, it's no news for you that the markets are changing much more frequently than we are used to see it in the past. And most of what's happening also right now was never seen before. And you might have also seen in the press that many hedge fund struggles, even the most successful and biggest ones like Rentec and Two Sigma, have problems to deal with the current situation. So our assumption, our core assumption is that first, markets change much more frequently. Second, that they change in an unpredictable predictable matter. And thirdly, that more and more data points are necessary to come to the right investment conclusions, which leads to the situation that traditional approaches to develop a trading model or to run a trading model might find a limitation sooner than later. Based on this assumption, in a very German way, we try to industrialize the invention process of new trading models. And this is important to understand. When we talk about AI, we are not an AI black box trading company. In our case, AI is not trading or generating signals. In our case, AI and machine learning is used as the, let's call it the factory line, to find new trading opportunities, to validate new trading models, and adapt them in a very dynamic way to the ever-changing environment. And what you see here is roughly our investment process, where our capital market experts start with an assumption, give an indication which underlying should be looked at in correlation with which factors, and then the machine, our platform, which is, by the way, filed for patent, because it's a very specific approach there, then does the legwork of building billions of permutations and finding out deviations from the current behavior, from current models, and profitable opportunities. Because we are doing this, we are able to combine also smaller profitable return buckets into one trading system, as we do in our volatility special opportunity program. This one is running for more than 4 years. I mentioned already average return is 16% a year. This year we are up around 29, close to 30%. So what the system does, it's a combination of various trading elements. On one side, it's a beta component, intelligently investing in a balanced portfolio. And this, on the other hand, is complemented with a set of crisis alpha strategies who tend to outperform in very volatile markets. Since we combine those two components, we have the chance to have returns in naturally or in almost any market conditions. So when the markets go down, when the markets go up, but also when they behave sort of in a very slow manner. As you see here, we have a look at just this year. You see that we started pretty much on par with the S&P 500. And then, the difficult times started, and our system, our strategy moved up. But more importantly, you can also see once the market, the S&P 500 started to recover, our strategy also moved up as well. So it's not just a defensive strategy. As I pointed out, it's a strategy which is designed to generate returns in various, also in good market environments. It's a strategy which provides daily liquidity. By nature, we are very short term in what we are doing. Since inception, the strategy generated around 90%, and Sharpe is above 1.2. With that, I would like to hand over to Mehdi, who is head of our volatilities trading, strategy trading program and derivatives trading, and he will have more insights on the strategy and how it works. Thank you.
Thank you, Stefan.
Thank you, Stefan. Let me just bring up the slide on my part. Hold on. I think right now you probably deactivated the screen sharing. I can't hear you right now.
Sorry, should be okay now. Sorry for that. My mistake.
It's okay. Let me just bring that up. Can everyone see it? Can you see it?
Yes.
Perfect.
Fine.
Super. Okay. So hi everyone. I'm Mehdi Sajid, head of volatility trading at QuantRock. I joined the company back in 2018. And before that, I used to trade options and future in London for one of the biggest option trading firm for about 8 years. So what is VSOP? VSOP is made of two main components. The first one being a balanced portfolio, where we have a long position in the S&P 500 futures and in the US 10-year future treasuries. This is a dynamic portfolio where the allocation for each of those instruments can vary depending on some trading indicators that we are looking at. So just to give you a better feeling, the allocation can vary from 15 to 30% for the equity part and from 60 to 80% for the fixed income part. And this allocation varies on the daily or weekly basis, really depending on those trading indicators. The second part or second component of VSOP, and the one that is probably the most interesting for our audience today, and the one that I believe makes us unique, is the volatility overlay portfolio, which is a set of fully automated algorithmic trading strategies that are triggered when certain conditions are met and use advanced machine learning techniques in order to make prediction and to find non-obvious pattern in the market. And we can divide this overlay portfolio into subsets, I would say. The first one is what I would call the alpha crisis strategies that we have designed to address our need, and we needed strategies that will provide us with a downside protection and perform in highly volatile markets. And the second subset is what I would call alpha improvement or diversification strategies, which is a set of strategies that perform in all market conditions, but especially in low volatile markets. Now, the balanced portfolio main purpose is to catch these market uptrends during bullish market phases where the volatility is low in the market, and therefore mechanically we have less trading opportunities. Hold on, can you hear me? Can you still see my screen?
Yeah, I can hear you.
Can you still see my screen?
I still can see your screen.
Okay, hold on, because I can't see the screen sharing anymore. It just stopped. There we go, we're back. So what I was saying is basically this balanced portfolio, the main purpose is to catch this uptrend. But obviously during these bullish market phases, the volatility is low, and therefore we have less trading opportunities for our overlay portfolio. However, we have skewed the allocation towards the overlay portfolio. And what I mean by that is that we could have given more weight into the balanced portfolio or the beta portfolio. And we would have certainly achieved a higher Sharpe ratio, closer to 1.5. But the consequences would have been that in scenarios like we had in March, when we have a market meltdown and panic in the market, the overlay portfolio would have only been able to offset the losses sustained by the beta component, rather than offsetting the loss and substantially outperform, which it did. This combination of a beta portfolio, alpha crisis strategies, and diversification strategies, if I may say, is in our opinion an optimal solution to perform in all market conditions. And I'd like to illustrate this statement by taking as an example 2019, which was quite an uptrending market, quietly uptrending with a low volatility. And our overlay portfolio contributed to 65% of this return, even though we had a low volatility and uptrending market, thanks to the diversification of those strategies. 2020, on the other hand, obviously, as we all know, very volatile markets, a lot of panic, a lot of uncertainty, and this translates in much more trading opportunities for our algorithmic trading part, which contributed fully for the performance of this year, which I believe up to date is close to 30%. For the overlay portfolio, it's a bit more, but we have a small loss in the beta component, which is linked to the market, obviously. But overall, I think we're close to 30%. Now, I think people will have interest to hear about the way we built the strategy, the way we use machine learning in our approach. So these alpha crisis strategies, the approach we have in building them is based on machine learning combined with domain knowledge expertise. So first of all, it's very important to emphasize that machine learning is not new and it's been out there for several decades. The only reason why it is more popular today and more efficient is for mainly two reasons, I would say. First, we have the computational power required to run such algorithms nowadays. And secondly, and I will think even more importantly, what is key to machine learning is the data. We have much more data available today than we had 20 years ago. It's even becoming a business when we have company providing data to feed the growing demand, and not only in the financial industries, but in all our ecosystem, and the data is becoming key. Now, obviously, there is a big gap between, like any other field of science, the financial industry is a good candidate for machine learning to be applied, thanks to the reason that I just gave. So it's quite a fertile field where you can apply it. But at the same time, there is always a gap between a domain of application of science and the reality. And one must put a lot of effort, a lot of thought, a lot of resources to develop its own way of applying this science, develop its own algorithm, its own model to overcome all of the weaknesses that surround this field. Machine learning is not an exception to apply in the financial industry. You need to overcome the weaknesses. And machine learning is a great tool and powerful, but can be quite inefficient if you don't choose with care the features to fit in the model. And what I mean by that is that we have quite a high ratio of noise to trading signal in the financial data, which can lead to overfitting. What I mean by that is that you can develop a model which by mistake will interpret a random noise as being a real pattern and trade on this, which is kind of what the black box strategies do. But to avoid overfitting.
Can I quickly interrupt? Do you have only this slide, or do you have
sorry, you know what? Thank you for saying. This is the ML part. I was a bit carried away, and here we go. So that's the ML part. Thank you. So just to come back, so to overcome basically these weaknesses, to avoid overfitting, and to improve our chances to find a robust model that will have a low variance. And what I mean by low variance is a model that is adaptive. That means that this model will be able to perform good prediction on data set that he has never seen before, which translates in reality in a model that can make good prediction on a situation it has never seen before. And that's the weakness of the statistical model compared to the machine learning model, and that's why we use it. And we have developed a unique approach where the framework of the model, the structure of the model, will be carefully chosen by the trading experts in the universe of realistic pattern, rather than using all of the parameters out there in the financial industry and listening to all of the field and try to make prediction, which will be a very complex model with a very, very low level of interpretability and will lead to a black box. And that's not what we do. So we have developed our own way. So to give you an example of two of our alpha crisis strategies, two of them are dedicated to take a long position in the S&P 500 implied volatility by taking a long position in the VIX future situationally. So one of the first challenges we faced when we built the product is that we wanted, as I said earlier, strategies that will outperform in volatile markets and provide a downside protection. But at the same time, we did not want to have the weaknesses of traditional methods of hedging, like buying put options or being long the VIX futures continuously and paying the spread and having to manage the position, and it can be quite costly. So we just used our domain knowledge and our understanding of the dynamic behind the implied volatility. So obviously, every time we have market meltdown, every time we have a big sell-off in the market, the realized volatility goes up, people seek more protection in the option market, which will drive the implied volatility up, and eventually it will lead to surges or to spikes in the VIX future. So we decided to focus on the VIX futures and monitor spikes in the VIX future. And every time we will have a spike in the VIX future, we will make a prediction on whether or not this spike will continue, and that will give us the chance to take a position situationally only when we think that there is ground for this panic to continue, rather than having a continuous insurance that can be extremely expensive. So here's how it works. The traders will give the parameters to the machine learning colleagues, which will develop a predictive model. But what they need is, first, what is the underlying we want to trade? In this case, this is the VIX round-month future. Second, they need, in what situation do we want this algorithm to perform? Well, here we want to be monitoring the minute data for the VIX future for any surge. But obviously, this is a kind of a subjective notion. You have to define mathematically what a surge means. And three, and probably more importantly, in machine learning, you have to suggest what are the features that are the more relevant to help us build this predictive model. So in this case, and this is not an exhaustive list, we will probably give them the S&P 500 prices, the VIX future prices, the realized volatility of the S&P, and we will monitor the option prices. We will monitor the skew levels, which is basically just the put-call ratio, and so on. And they will come with a predictive model that takes in account all of these parameters and give us a prediction every time those conditions are met, and with a level of confidence along. Every time we have a trading signal, we will trade proportionally to the level of confidence. What I mean by that is that we will certainly, or more likely, trade the full allocation of the strategy on that day if we have a strong trading signal with a high level of confidence. And inversely, if this smaller, we will trade just a portion of the strategy. To give another example, in addition to that strategy, we have another one that uses the same philosophy, the same approach to build the strategy, and monitors the difference between the implied volatility and realized volatility. And every time the realized volatility is drifting away from the implied volatility, we will make a prediction on whether or not we think this spread will continue to widen, and we will take a position as long VIX future to arbitrate this discrepancy. Now, I don't know if we have much time, so I will probably stop on these strategies here, but I would just say that they have performed tremendously this year, and especially in March. And more remarkably, we have been able to catch the spike in the VIX future in June, when we had, I think it was the 11th of June, where we have one day a big sell-off. So just a few words about our risk approach, and then I will be finished. We use an optimizer program that calculates the allocation for each strategy and maximize the Sharpe ratio with a set of constraints, among which target volatility of 10% annually and a limitation of the allocation for each strategy, and to a greater extent, a limitation per instrument, as we can have a situation where two strategies trade at the same time. Just going to move to the next slide for the risk part. So, and basically we run this program on a frequent basis so that we can adjust the allocation for each strategy, taking into account market changes. And basically this is volatility of each instrument. So the more volatile the instrument, the more risky it is, and we will reduce the size of that strategy dynamically. Finally, we used a few risk metrics, mainly the value at risk. We used a sophistication of the Gauge model in order to assess our volatility. And for the longer horizon, we extensively use for the VAR 9510 days, for instance, bootstrapping techniques. But in our case, to be more precise, it's a block bootstrapping, given the nature of our product. We don't have continuous position, but strategies that are triggered. Now I think I will probably stop there. I'm pretty much sure that people in the audience have questions. We will try to answer as many as we can. And if you have more interest, you want to hear more about our product, we'll be very happy going forward to organize face-to-face meeting on Zoom and address those questions. Thank you very much, and I will hand over to Rainer.
Thank you very much, Mehdi. This is much appreciated, very interesting. Just want to bring up Beat for a very, very quick summary, 2 minutes, and then we move on to the Q&A. Here we go.
Okay, thank you very much, Rainer. So the summary for the Global Alternative Smart Alpha AMC, what is it? It is a diversified alternative multi-strategy investment solution and with a market-neutral bias. It is uncorrelated, risk-controlled, diversified, and has a monthly liquid portfolio. It consists of 7 carefully selected and combined managers. 2 of them you just saw presenting their approaches to you. In terms of investment style, roughly 60% of the portfolio is systematic and 40% is discretionary. Overall, the portfolio has a market-neutral bias, as said before. Target returns are between 8 to 9% per annum, net of all costs. Minimum investments are $10,000 US, euros, or Swiss francs. We suggest an investment horizon for the investors of 3 years plus. And I think this is very important. The custodian and paying agent is Banque Cantonale de Fribourg. And the structure of the portfolio is a so-called PCC, Protected Cell Company, which means that all the assets of all the AMCs, all assets are segregated. Now, next page, please. Thank you, Rainer. Now, to give you an idea what such a portfolio could do for you, we back-tested the performance from January 2018 until end of October of this year. The blue line represents the Global Alternative Smart Alpha AMC. The gray line is the S&P 500 Total Return Index. The black line is the Swiss Market Index. And the yellow line is the Hedge Fund Absolute Return Index. Now, the focus of the Global Alternative Smart Alpha AMC is downside protection and achieving attractive absolute returns. And as you can see on this performance chart, the downside protection was achieved during severe market corrections in 2018 and more recently also this year in 2020. The maximum drawdown was minus 2.21% in September of this year. And year to date, all throughout the year or by the end of the year 2018-19, as well as year to date, the AMC achieved positive returns. Now, all these performance figures are back tested in US dollars and net of costs. If you have now an interest to learn more about this unique investment strategy, then please reach out to us for the term sheet or any other documents which you might need for your due diligence. And with that, Rainer, I think I hand back to you for the Q&A session.
Thank you very much, Pia. So let's move on to a couple of questions which have been typed in. One is for Roy, basically asking about your view on the US election. What do you think will happen next? You know, how you behave in certain kind of possibilities, either big Biden or big Trump. So that would be, you know, one question.
To me, there's the short term, where does it go through February, and then what is the impact beyond February? My view is that it's still a long shot. I think I have to take the view that the people betting on this have come up with a good summary answer, that there's about a 15% chance that Trump still is in office on February 1. I think we're going to learn a lot about fraud and how our elections have been compromised, although I don't necessarily think that it will be enough to put Trump over the top. The current situation is on another contract, they have the percentage chance that the Senate will be Republican. Now that's important because if we have a Democratic president and a Republican Senate, that really puts a barrier as to what can change. And I think that's one reason the stock market is up. That contract is at about 88% that whatever happens, it's going to be a Republican Senate. So in that case, I think what we're seeing is kind of a positive situation for the stock market all the way out, because there really can't be any changes from what was already a very positive situation from the stock market. The problem is I'm not a macro guy and I don't really know what's going to happen. And while I wish that I could pound the table and tell you how clever our analysts are to come up with this great opinion, I'm pretty much going to say that it's no better or worse than anyone else's on this phone call. So to me, the proper question to be asking is, what are the risks in our own portfolios? What are the risks in my family's portfolio? What are the risks on your own people on this call's portfolios and the ones you manage for others? And to me, clearly, the downside in equities and the downside in fixed income are the most dangerous, because especially now that stocks have risen so much, there's a lot of long equity exposure and it's growing and growing and growing each day. So the value of a diversifying fund like this is that it seems to have tremendous resiliency in the event that stocks go down. And then we have to also consider very strongly the possibility that the central bank balance sheet expansion, which under whichever administration we end up with, is going to continue. We just don't know how much the Fed is going to print, how much the other countries are going to print. Eventually, there is a number that will filter back into inflationary pressures and pressure on the long end of fixed income. And in that situation, as we saw earlier, it's very hard to find funds that make money. So I just remind everyone to think about whatever happens, the fixed income situation, rising interest rates are a possibility that can be very dangerous to portfolios, as well as declining equities. And if stocks go up, I think we'll be all okay under whichever administration there is.
Many thanks, Roy. Maybe one question for Stefan or Mehdi. Someone is asking, how many strategies do you manage in that overlay part of your portfolio?
I can answer that question if you want, Stefan, or go for it.
No, go.
Okay. Well, we have about 8 strategies at the moment. As I said earlier, 2 of them are dedicated to downside protection. One of the alpha strategies is can take a long bias actually in the equity market, which is kind of a proxy of selling the VIX futures, but we don't like the risk associated with being short the VIX future. So we have a strategy that will basically monitor the market, especially during phases of drawdown, and make a prediction on whether at one point the market will bounce back. And therefore, since we've seen a the implied volatility going up, and since there is a lot of premium in the VIX index, it can be a very good opportunity to harvest that premium and selling the vol. But since we don't like doing that, we do as a proxy, a prediction on those days after a few days of sell-off, if the market will bounce back, and we take a position into the S&P 500 for the day. So most of the strategies will have a horizon of 1 to 2.5 day maximum, 1 to 2 days. And we have about 8 of them in total at the moment.
Okay, thank you very much. I think given the time constraints, I think we should stop now. So I really would like to take the opportunity for a big thank to you, Roy, Stefan, Mehdi, and Beat. I think we covered a lot, and I really hope that you did find it useful and interesting. Should you have any additional questions, please do not hesitate to contact or the managers directly. Again, many thanks for listening in. We wish you all a good rest of the week, and please stay safe and healthy. With that, thank you very much, and speak soon. Bye-bye.